Meantime, record closes across the board as the Fed announced this afternoon that it is cutting rates by another 25 basis points. Joining us now is Vincent Reinhart. He is chief economist at Dreyfus and Mellon and a former Fed economist. And it's great to have you on. Thanks.
Thanks for having me.
Your takeaway from the Fed decision and the Powell presser today, it seems like he was very determined not to make news, including not commenting on the future trajectory of rate cuts and what that path to neutral looks like.
As for the first thing, we learned that Chair Powell's not self-destructive. There's no reason for him to talk about the election. He will already, his institution will be under pressure from politicians in the months to come. He doesn't have to add to it. So he stayed in his own lane, which was economic policy making, and he's happy in his lane right now. He's upbeat on economic activity, not that concerned about inflation, and was really in a position to think about when to dial back monetary policy easing. Not immediately, but sometime next year.
I mean, he did talk up the dual mandate as well, and he made comments about the state of the labor market and the fact that it's basically less tight than it was pre-pandemic. And I just wonder how much to make of that, given the fact that labor data can be a lagging indicator and it can move very quickly in different directions.
So a couple parts to that. And you identified the important part at the beginning. His characterization of the labor market back at his Jackson Hole speech, which got a lot of attention, was they didn't want the market to get worse from where it was then. And in an answer to a question today, he said, well, we wouldn't want it to get much worse. He actually softened the take a little bit. And part of it is, you're right, economic data are always variable, it's always volatile, and it's just getting harder and harder to sample. And the Bureau of Labor Statistics has a really hard time. Employment situation is measured with a lot of uncertainty, and we've had strikes, we've had storms. They have to smooth through this information to get the underlying trend, but they're upbeat about the underlying trend.
David Zervos made the point that we've basically seen a round trip in 10-year Treasury yields from the reaction to the election to over the last couple of days to now the digestion of those results as we get them in today's trading session. And I wonder what you make about what the bond market is signaling. Powell certainly is not willing to play ball on the possibilities around fiscal policy and how that could potentially feed back into monetary policy. But when you start talking about changes to immigration, when you start talking about changes to trade and application of potential tariffs, when you start talking about changes to the tax code and lowering those or making those more permanent, how does that potentially feed back to the monetary piece of this?
Okay, so there's three parts about what's been moving long-term yields over the last week in particular. One is getting realistic, understanding that premiums should be higher, that the market economy works at a higher base rate. Second, we learned a little bit about monetary policy today. The Fed is not on a one-way ticket to just easing. They will take into account the data, and at some point they will stop easing and certainly slow the pace. What was the key word Powell said? Patient. Patient means not every meeting, and that decision's coming soon. But the big thing was about governmental policy, fiscal policy. We're going to have big budget deficits. We're going to be adding to debt. We are going to probably do things that are somewhat intrusive and expensive, like potentially tariffs. And so there's lots of reasons to be worried about the longer term willingness of investors to continue to add to Treasury debt.